In part 2 of stock valuation, let's investigate a little bit further some mathematical techniques to try to determine the value of a stock. So the first thing we'll talk with is try to figure out what is the relationship between risk and return, or how can we measure that to some extent. And what we develop is something called the required rate of return. And essentially, this is a number that is compensates us for the risk that we see in a particular investment. So how do we, excuse me, how do we ultimately determine this value? The risk-free rate of return comes from the average rates of returns on Treasury securities. So typically we're going to use a 20 or a 30-year Treasury bond, determine what the yield is. We can look that up in Yahoo Finance or Bonds Online. There's a FINRA site, it's a finra.org, I believe, that you can look up and find risk-free rates. We also need to know what is the average rate of return on the stock market. We've looked at this a little bit earlier in another chapter, and we've determined that the average rate of return for large stocks excuse me, is in the ballpark of 11%. So if we say that the risk-free rate is 3 and the stock market return is 11, then we take the number 3% plus 11 minus 8, 3, that's 8%. So a 3 plus something times 8. And this stock's beta, we've talked about this, beta is a measure of the market risk of the stock. So this is the risk that we want to know about investing in stocks. So the market return minus the risk-free rate gives us the risk premium for investing in the stock market on average. And then when you multiply that by the actual risk of the stock, it adjusts that risk premium for the specific stock that we're talking about. So here we have a stock has a beta of 1.3. The risk-free rate's 5.5%, and the expected return on the market in this case we're saying is 15%. So what's the required rate of return? If you use the portfolio beta and return worksheet, you can plug these numbers in quite simply, and you can see that we end up with a return of 17.85%. So this required return is the minimum return that we would accept for investing in this particular stock. What we need to calculate, that's what we're working with for the rest of this chapter, we need to calculate what do you think you'll get if you actually buy this stock. So we have lots of models with which to use. You can see there are several of them here. We're not going to discuss them all, but I just want to give you a picture that there are lots of different kinds of models that we can use when we're trying to find the value of stocks. We should probably use as many as we can so we can narrow down and maybe average some numbers out or find a ballpark that makes us kind of comfortable. I'll also say that not every stock works with each of these models. Some are better than others, and some are actually not very good at all for certain industries and certain kinds of stocks. So the first model we want to talk about is called the dividend valuation model. This is a time value model. It assumes that we're going to estimate or have a forecast of dividends to infinity, and we have a very basic formula. The value of a stock is next year's dividend, D sub 1, divided by K sub S minus G. K sub S is the required return. That's the thing we just calculated a second ago. And G is the growth rate of dividends. Now we would like this to be the growth rate of future dividends. Of course, that requires us to forecast what that man, what that future rate might be. So how do you find D sub 1? D sub 1 is the current dividend, D sub 0, multiplied by 1 plus, again, the growth rate of dividends. So let's look at an example. We have a preferred stock that has 0 growth rate. So how do we plug this information into the stock valuation worksheet? The preferred stock pays a dividend of $6. Its required rate of return is 12%. So where it says last, D0, that's the first thing you need to know. You need to know today's dividend. So you type in $6 for dividend. On the left-hand side of the spreadsheet, you'll see the 3 variables. We need to know K sub S, we need to know the growth rate of dividends, and we need to know D1. So in this case, when you estimate the growth rate, we're not really going to estimate, it's a preferred stock, so the growth rate is 0. That means next year's dividend will be the same as this year's dividend, which is $6. We're told the required return is 12%. So this stock would be worth $50. So that's the most that you'd be willing to pay for it. The required rate of return is 12%. That is the rate of return, the minimum you'd accept in order to purchase this particular investment. Now, if we go out and we look up on the internet and we find out this stock is selling for $47. Well, quite simply, would you pay $47 to get something worth $50? Well, sure you would. So that the cost of the stock price is less than the expected price, which means that this stock is currently undervalued. You'd like to buy this. The expected return is 12.76. We wanted 12% as a minimum, and if we buy it at 47, we expect to get 12.76. So this is a good investment for us to make. Now, sometimes the problems give you a little bit of a curveball, if you will. In this one, see, the common stock is going to pay a $3.50 dividend next year. So we don't know D0. We know D1. So I've created or put a box that says, look, if D1 is given, you need to enter it here. That says $3.50. When you do that, you notice that it plugs it right into D1. So here's D1. So we don't need to put D0 here. Quite frankly, we don't know D0. But again, add the K sub S of 17% for this stock and the 9% growth rate for the dividends. This has a value of $43.75. What's the current price? Current price is $47. Would you pay $47 to get $43? Certainly not. If you did, you would be expecting to earn around 16.45%, but yet you required 17%. So this stock is actually a bad investment. You should not purchase this stock for an investment portfolio. You're not going to be compensated for the risk that you see in the stock. So now let's go back and you have to remember, when I use this common stock valuation spreadsheet, when I close the file, when I end my working with this exercise, I don't save it. So that way I don't ever worry about numbers being in that D1 box, because if they're there, it's gonna you're not going to get correct answers. So here, the most recent dividend is $2.65. That's right there. You put that in as D0. You're told that dividends are going to grow at 50%. The required return is 20%. So this stock has a value of $18.55. Again, the stock price is 20. You wouldn't pay 20 to get 18. And likewise, if you did pay 20, you'd earn 18.9%, and you wanted 20%. So this particular stock, again, is not a good investment. And again, I think this spreadsheet is fairly simple to use. It looks a little bit more complicated. There's a lot of stuff at work there. But if you think about the general information that you know, plug in the information you're given, in the end, it's fairly mechanical to end up with the right value. What about a variable growth model? In this case, what we're talking about is a stock that, for one reason or another, doesn't grow at a constant growth rate. This is typically what you might think would happen with a, say like a pharmaceutical company or a technology company that has lots of inventions, lots of innovation. There will be time periods where they experience rapid growth. And when they have this rapid growth, there might be opportunity for dividends to grow at a higher than average growth rate for a certain period of time. So to find the value of this stock, we need to know what the dividends are going to be during this supernormal or variable growth period. And then we need to find the price at the end. And this is I don't want to say it's complicated, it's a couple of extra steps to do. So let's think about what information we might need to know. This company is currently paying a $2 dividend. Normally, this stock grows at 8%. But because of an invention, they expect to have some supernormal growth rate of earnings and dividends. They expect to grow at around 15%. So this 15% growth rate, though, is not going to last forever. It's only going to last for 3 years. So the required return of this company is $12, and its current stock price is $62.75. So we have this period, 3 years, with super or variable growth rate dividends. So we need to calculate the present value of these 3 years of dividends. Find the present value, you add those present values up, it's $6.33. The other thing we have to do then is we need to find the present value of a future price. What's the price going to be here? Well, if you click on this $58, you'll see there's a formula, and that formula is our Gordon model formula we used a second ago. But it's not looking at today's dividend. It's not looking at D1. It's actually looking at D4 because I need to know the dividend or the stock price 3 years from now. So if you remember, our formula was D1 divided by, well, that's if we're talking about today, which is D0. So D1, 3 years from now, you have to add 3 to that. We need to know the 4th year's dividend. When you add those two together, we end up with a price of this stock of $64.78. Again, this is another spreadsheet, right? The other one isn't going to do this because the other one assumes a constant growth. So this is the supernormal growth stock dividend worksheet. It's very simple. We have 6 inputs. You have to be given all of the inputs in order to solve for the problem. Again, the math is done for you in the end. There's another form of technique that we could use. It's called the dividend and earnings approach. It's similar to the variable growth stock. We're going to use present value. We're going to assume that the stock value is capitalized, is the capitalized value of all of its annual dividends and its future sale price. But the thing that's nice for this is going to work for companies that pay very little or no dividends. So the present value of a share of stock is the present value of future dividends and the present value of the stock at a date and time. So let's think about the variables we need to know. Well, what year are we talking about? We're looking to find this stock or what the price of the stock will be in 2007. It's currently 2006 in this example. What information do we know? We happen to know, we looked up the earnings per share of this company, and we have from 2002 to 2006. I know what the earnings per share of this company are. I also know what dividends were paid out per year. Since I know dividends and earnings per share, I can calculate the average dividend payout. Here's the payout per year. You average it out. On average, this company pays 35% out in dividends. Their historical earnings per share growth rate was about 10.97%. So that information gives me some information essentially about the earnings and how dividends are paid within this company. What other information we need to know? Well, we know the current earnings per share is $1.85. It's over there. We're actually going to estimate that the growth rate it's 10.29 here, so we're just going to average it to 10%. This company has a 12% required return. How did I find that? Well, right below here, you can calculate risk-free rate, beta, the average rate of return in the stock market. This company averages around 12%. So I have the earnings per share. I know the estimated earnings per share growth rate. I know the required rate of return of the stock. And we also calculate or estimated the dividend payout. The only other piece of information I need to know is what is the PE ratio that I expect for this coming year. So how does it work the data? Well, first thing we need to do is find the present value of the next 5 years worth of dividends. Here's the years. Here's the earnings per share, which is based on the earnings per share growth rate starting at 2006. We know what the estimated dividend payout ratio is. Here's the forecast of dividends, and then the present value of those. So the present value of these dividends is $3.44 5 years from now. Or that's today, but over the next 5 years, what dividends you expect to get. The earnings per share, $2.97. Again, we get that here's in 2000, the last year of earnings per share. We need to forecast what the PE ratio will be 5 years from now. We're estimating it's going to be 22. Now, we can typically find 1 year. Finding 5 years of a forecast is a little bit tougher, but we can ultimately, work with and try to adjust what we think's happening with the company. So in the end, the price using the multiplier model is $65.55. Present value, that's $37 odd. So the present value of this company's stock, present value of its estimated dividends, plus the present value of its price, gives us a stock price of $40.63. And again, we would compare that to the current stock price of this company. So to kind of go through real quick a little bit about this adjustment with multiplier models, one of the estimates we've been talking about so far is using the PE multiplier. And as you can see here, the PE ratio is stock price divided by earnings per share. So if you solve that algebraically, the stock price is earnings per share times the PE ratio. If you estimate earnings per share, say, what do you think the earnings per share are going to be next year? And if you have a forecast of the PE ratio next year, that will give you an estimate of the stock price at the end of this year, at the end of year one, if you will. There are other multiplier models just like this. The next one is something called the price to cash flow model. The price to cash flow model is the market price of the common stock divided by the cash flow per share. To find the formulas, you just solve for market price. So the market price is the company's price to cash flow ratio multiplied by its cash flow per share. Again, forecasting the ratio and or the cash flow per share for 1 year ahead, you can calculate what you think the value of the stock will be in 1 year. There's another one. There's one called the price to sales ratio. Exact same ratio. These price to sales ratios, the ratios that we're talking about, are typically published in many places. So you get this number today, you just need to forecast what you think sales per share, cash flow per share, or in this next case, what you think the book value per share is going to be. You just need to calculate what you think those are going to be, and you'll have a series of multiplier models to help you estimate the stock. So here we have some examples. The PE multiplier, PE ratio is 15. We estimate earnings per share to be 5. So the value of this company's stock should be around $75. The price to cash flow, 7.75. Estimated cash flow per share, $5.25. The value of the stock here is $40.68. The price to sales, $3.05. Estimated sales per share next year, $6.49. So the value of this stock is estimated to be $50. It's currently worth $46. So these top two things say that, look, if you buy it today for $46, you're going to make money by next year. Now, the price to cash flow ratio model doesn't give us that answer. It conflicts with those. But that's all right. We have many different models to use. We've talked about several other techniques. If you use all of these techniques, you will find that they accumulate or bunch around a certain range, and you can kind of feel that the stock price would be in that area. And again, as long as your current stock price is less than what that grouping is, you can be pretty certain that the stock price will rise in the future. Again, that's kind of a rough estimate and a rough discussion of how you find the value of a common stock. One thing I would tell you is I wouldn't use these techniques on my personal investments, mostly because we have left out an awful lot of research. We've left out an awful lot of information. We're really kind of cheating the model, if you will, to see how the model works, but not necessarily gathering all the information to see how accurate the model might be. I'll see you in the next chapter.